How much is your business worth? What kind of things do buyers find valuable? And what can you do to improve your business valuation? I'm Malcolm Zoppi, an English qualified solicitor. In this video, we'll discuss business valuations. We will go over three main valuation methods. First, the asset-based method. Second, the earnings multiplier or EBITDA multiple. And lastly, the discounted cash flow method. Fantastic. Let's get started with chapter 1, the asset-based valuation method. In short, this is when you take the value of the assets of the company, you deduct the liabilities, and that's how you arrive at that valuation. It can also be referred to as a net asset value method. This kind of valuation method is typically used with asset-heavy businesses like real estate or intellectual property holding companies. You can improve the valuation of this business in a very simple way. You can either increase the value of the assets, for example, by if it's real estate, reinvesting and refurbishing, or secondly, paying off liabilities. If they're mortgages, you can try and minimize those. Fantastic. And moving on to chapter 2, which is the earnings multiplier or EBITDA multiple. So this is the most common way to value SMEs, and it uses your EBITDA, which is earnings before interest, taxes, depreciation, and amortization, and applies a multiple based on your industry standard. So we look at effectively earnings, how much money or cash flow is being generated by the business. We put a multiple, so we multiply it, say, by 3 if the industry standard is 3, and that's how you arrive at the business valuation. So this type of valuation method is typically used when there is a stable and profitable business in an established market. So it's quite reliable. We can rely on the EBITDA that's being produced. We expect it to stay the same, and therefore this valuation method is a reliable one. So how can you improve your business valuation under this method? First, you can try to argue with the buyer that a higher multiple should be used for whatever reason. Secondly, for example, you can try to increase the EBITDA by, for example, for a period of time, not running costs that you might typically run through the business, but don't need to be run through the business. Now, before we discuss the discounted cash flow method, feel free to email me if looking for professional legal advice. With our legal advice calls, there are no charges, no obligations, and no nonsense. Contact me now at info@zoppi.co.uk. Fantastic. Moving on to chapter 3, which is again the discounted cash flow method. So typically, this tries to estimate the future cash flow of a business, even on a multiplier basis, as we just discussed, and then it discounts those earnings back to present value. So what does that mean? Why do we do that? It means that if we're making £3 over 3 years, those £3 in 3 years are worth less than £3 today, and therefore we shouldn't be paying £3 today to hopefully get £3 in 3 years. The reason why that money is worth less tomorrow is also because of inflation. Accordingly, that's why we look at future earnings and we discount that back. So this kind of valuation method is typically used when there are high growth companies with fairly predictable revenue. So you can improve the valuation of your business under this method by, for example, justifying to the buyer why you believe the revenue in the future will be even greater than expected, and therefore those earnings are going to be greater, from which we can then discount. Secondly, when it comes to the discounted cash flow method, there are two main values that are taken into consideration. First is, simply put, the kind of earnings that we're getting over a period of time, let's say 3 years. Typically that would also coincide with the deferred payment period. So if the seller is going to pay the buyer over 3 years, then typically we would look at earnings over 3 years and discount back. But after those 3 years are over and after the seller has been paid off by the buyer, there's still residual value with the business, because the business, it theoretically would remain. Businesses are expected to go on indefinitely unless something states otherwise, and therefore we still have value at the end of that period. This is typically referred to as the terminal value, when you as a seller of the business will want to argue why that terminal value should be taken into consideration more and why that value should be bigger. So if you've got any questions, feel free to put them in the comments below. I promise I will answer any questions that you may have. Now, if you want to find out more, well, for example, the kind of taxes you might need to pay when you sell your business, make sure to watch this video right here. Thank you for watching.